Yes, so the question reads, the following are the summaries financial statement of 𝗂𝐻 Limited as at 31st of October 2020 and 31st October 2021. First of all, we have 𝗂𝐻 Limited statement of profit or loss. In that statement of profit or loss of the income statement, we have sales, cost of sales, gross profit, distribution cost, administrative expenses, interest received, interest paid, profit before tax, taxation, and then we have the profit for the year. Then we have the statement of financial position. Remember, always in any question for cash flow, you'll be given the balance sheet or the statement of financial position for the previous financial year and the current financial year. So what you have there include the non-current asset, we have property, plant, and equipment, intangible asset, and then we have investment. Under the current asset, we have inventory, account receivable, short-term investment, and cash. Now, in this question, I hope you can see there is an item which you're given at the current asset, which is called short-term investment. Now, anytime you're given a short-term investment, we say that this is considered to be cash equivalent. Is that considered to be what? Cash equivalent. You have to remember that. And then we have equity. At the equity, we have share capital, share premium, revaluation reserve on property, plant, and equipment, retained earnings. And then we have the non-current liabilities, which include long-term loan. And then at the current liabilities, we have account payable, bank overdraft, and taxation. And then we have the total. Then we have some additional information number 1 up to note number 4. And then what you're required to do is we prepare a statement of cash flows in accordance. A statement of cash flows in accordance with what? In accordance with the requirement of IAS 7. For the year which ended 31st of October 2021. Equally, in this question, you can see the examiner here is not specific on which method to use when preparing our statement of cash flows. But remember what we said is that anytime you come across a question for cash flow, you're given income statement and the statement of financial position, always, we said you apply which method? The indirect method. When computing your CFO, when computing the net cash flow from the operating activities, you start with the profit before what? Tax. Now, before you prepare a statement of cash flow, what do we need to do? We need to go through the notes and we see what we are told. We do the workings which are required. So in note number 1, we are told the proceeds, is that the proceeds or the process? No, that word should was supposed to be the proceeds. The proceeds, not the process. That was a typing error. So the proceeds of the sale of non-current investment amounted to 60 million. So basically what on that point number 1 refers to investment which are classified as part of the non-current asset. Can we go back to the statement of financial position? In the statement of financial position, specifically at the non-current asset, we have 3 assets there, which include PPE, property, plant, and equipment, intangible asset, and then investment. Point number 1 is referring specifically to those investments. Those investments at the start of the year, you can see we are given our balance sheet for 2 financial years, or statement of financial position for 2020 and basically 2021. We said the balances which are given here are the opening balances, and what we have here are the closing what? Balances. So those investments at the start of the year, you can see the value for the investment at the start. At the start was what? Was 500, but the value for this investment at the end of the year is nil, is 0. What causes the value of an asset to reduce from 500 to 0? It is automatically due to the sale. Now, in note number 1, we are told that this particular investment, which had a value of 500, we are told they were sold at 600. They were sold at what? 600. So meaning that because they were sold at an amount which was more than their value, then automatically that means that this particular investment was sold at a profit, or in other terms, we can say that they were sold at a profit. That is at a profit or at a gain. So the gain here will be what? The sales proceeds, 600, minus their value, which is 500. So they were sold at a gain of what? 100. So this particular gain, we said any gain or profit on the sale of asset is accounted for as an income in the income statement. And this income, we said, is a non-cash item. So therefore, I think we can have that computation here, or that working here. Remember, you said these workings are very, very important. So for number one, we determine the gain on sale of investment. The gain on the sale of investment, we have said, we consider the sales proceeds, or we compare the sales proceeds with the value of those investments. So, and the gain is 100. So this gain, we have said in the income statement, it was accounted for as an income, but basically we know that this gain or this profit on the sale of an asset is a non-cash item. So therefore, in preparing our statement of cash flow, as far as the sale of those investments is concerned, we are going to consider two items. One, this gain or this profit of 100 will be deducted from the profit. Now, it is obvious, if you go to the income statement, you'll not be able to see this profit, because we said any profit or any loss on sale of asset is included as part of the cost of sales, So therefore, this was included as part of the cost of sales. And because it's a non-cash item, we are going to less it from our profit. We are going to less it from our profit too. When computing the cash flow from investing activities, we are going to take into account the actual money or the amount of money received from selling in, this investment. After the company sold this investment, the company received how much? 600. This to the company is a cash inflow. So those are the two items we are going to consider there when preparing now our statement of cash flow. So let's move to note number 2. In note number 2, we are told an equipment with an original cost of 1.7 million and a net book value of 900,000 was sold for shillings 640 million. During the year which ended 31st October 2021. So this is an item of equipment which was sold. We said anytime you are told an item of PP was sold, you have to prepare something called a disposal account with an objective of determining the gain or the loss on what? On disposal. So that should be working too here. We prepare what? We prepare the account which is called what? The disposal account. Remember, on Saturday, I showed you the two formats you can use to prepare this account, to prepare this particular word, disposal account, because we say there are two formats you may use here to prepare this particular account so that you can determine whether such an item was disposed at a gain or at a loss. I think we can use the format which I showed you on Saturday, whereby on this side we record the cost of the asset. Then on the credit side, we record two items, the accumulated depreciation and the sales proceeds. The sales proceeds, we compare, or basically we record the cost on that side and those two items. And then from there, we balance our account. A balancing figure on the debit side is a gain. A balancing figure on the credit side is what? Is a loss. So which items are, or which values are we given here as far as the disposal of that item of equipment is concerned? One, we are given the original cost, which was 1.7, and take into account all our figures are in thousands of shillings. We take that as 1,700, not 1,700, is 1,700, and then we are given the net book value. The net book value, what is the net book value of an asset? Net book value is the cost minus accumulated depreciation. So the net book value here is given as 900,000. The cost is given as 1,700. So what we are not given here is the accumulated depreciation of this item. And that's what we need here. So we need to compute the accumulated depreciation as the difference. So our accumulated depreciation, we can assume it is X. We bring X to the other side. So we be left with 1,700 here and then 900 to the other side. So which would be negative 900. So our accumulated depreciation, which is X, this one would be what? 800. So therefore the accumulated depreciation of this item is 800. And then also in note number 2, we are told it was sold for 640. Now this 640, this 640 is the sales proceeds. Is the sales proceeds. This is the amount at which the asset was sold at. Sales proceeds. Sales what? Proceeds. Sales proceeds. So what we need to do is we balance our account. We balance our account, we determine whether we have a gain or a loss. So balance that account for me. You tell me whether we have a gain or a loss. A gain or a loss. A gain or a loss. What is the problem with my board? Someone is saying my board is not clear. My board I can see is very clear. Anybody else having a problem with my board? Anybody else having a problem with my board? My board is okay. So we said when, yes, make sure you always check on your internet. Your internet, you need to check on your internet when joining the class. Make sure your internet is okay. Make sure your internet is okay. Yes. So that is the balancing figure. A loss of 260. So mean that item was disposed at a loss of 260. And equally here, when preparing our statement of cash flow, we're going to consider how many items? 2. 1, we're going to consider that loss, which you're going to add back to the profit because it has been added and it is an non-cash item. 2, when computing the cash flow from investing activities, we're going to take into account the sales proceeds, the amount of money received by the company after selling that what? Asset. This is an account we said we should be in a position to prepare. You can see in the 3 questions you have done, the question for December, the question for August from your paper for FRA, we prepared that account, and also in this question you can see we have prepared that what? Account. Disposal account, that is an account you have to, you must be in a position to do what? To prepare, just like the other account we said, the PP account. So those are some of the workings you should be in a position to do when doing this question for cash flow. So then in note number 3, we are told the following information relates to property, plant, and equipment. Now, which is information are we given there? We are given information about the cost of the PP at the start and also at the end. Remember, I've said those balances for 2020 are the opening balances. The balances in 2021 are the closing. So what are we given here? We're given the cost of the asset at the start and also at the end, and also we're given the accumulated depreciation at the start and also at the end. Now, just like what we did in the question for August, the question we tackled on Saturday, we prepared 2 accounts. If you can be able to remember, we prepared the PP account and we prepared that account at cost. I hope you can remember that. We also prepared another account called the accumulated depreciation account. So we need to prepare those 2 accounts equally here with an objective of what? 1, we need to determine how much was the depreciation for the year. We can only determine that depreciation for the year because in this question, you can see we are not given the depreciation for the year. We can determine that by preparing the account called the accumulated depreciation account. We also need to prepare the PP account so that we determine were there some items of PP which were acquired, just like what we did on Saturday. So we need to prepare those 2 accounts here. 1, we prepare the PP. And remember here we said now, anytime I mention PP, you need to remember that we are talking of property, plant, and equipment. Property, plant, and equipment, we say that these include all tangible and current assets. All tangible and current what? Asset. All tangible and current assets. So we need to prepare the PP account and the other account which is called the accumulated depreciation. The accumulated depreciation account. Accumulated depreciation account. Accumulated depreciation account. Yes. Now, for us to prepare these 2 accounts, we said the first thing you should record is the opening and the closing balance. The opening and the closing balance. We said PP is an asset account, and therefore the opening balance in this account should be on the debit side, and then we record the closing balance down there, And also we have said that anytime you have to prepare these accounts, the accumulated depreciation account, then we say that this account you prepare it at cost. You prepare it at cost. But if you're not preparing this account, if you're not given the accumulated depreciation, then you prepare this account at net book value. Like the question for August, is it for August? No, for December 2022, the PP account which we prepared that account at net book value. But if you check on the question we did for August 2022, we prepared these two accounts, PP and accumulated depreciation account, and therefore this account we prepared this account at cost. That's what you need to know. If you're not preparing this account, the accumulated depreciation account, this account always is prepared at cost, not at cost, but at net book value, and the depreciation is credited here. But if you're preparing this account, then that account you prepare it at cost. So we record the opening balance in this account, and I've said we prepare this account at cost. So we are taking the information we have in note number 3. What is the cost of the PP at the start? The cost of PP at the start was 11,900. At the end of the year, it was 14,400. And then equally, we need to record the opening balance in this account. This account, we said, because it's a provision account, the opening balance is a credit balance. The accumulated depreciation at the start, 58. The accumulated depreciation at the end of the year is what? Is 68. Is 68. Yes, so that's what we need to record there. First of all, the opening and the closing balance. And then from there, we also have other items affecting these accounts. So let's go first of all, we go to note number 2. We go back to note number 2 here. Note number 2, in the additional information number 2, we are given an item of equipment which was disposed. An item of equipment is part of the PP. And what we say is that once we have an item of PP which has been disposed, because it was part of the opening balance, we need to eliminate it from this balance by crediting this account, and we credit it here at cost because this account is prepared at cost. What is the cost of that equipment? The cost of the equipment which was sold was 17. That is the first item we record there. 2, that item of equipment which was disposed, it had an accumulated depreciation which you have computed here of 800. Now that accumulated depreciation of that item was part of this accumulated depreciation at the start. And because the item has been disposed, we need to eliminate that depreciation here by doing what? By debiting this account, the accumulated depreciation on the item which was disposed. Now, what else are we given as far as the PP are concerned? Note number 3, we don't have anything else here which will affect this, but there is something we said here always we should check in the balance sheet, specifically under the equity, and that is something called the revaluation reserve. You should go to the statement of financial position, specifically under equity. You check whether you are given the revaluation reserve. Do we have revaluation reserve? In this case, yes. The revaluation reserve at the start of the year was 1820. The revaluation reserve at the end of the year was 2000. So in this case, we can see the revaluation reserve increased from 1820 to 2000. So this increase in revaluation reserve, we said is due to something called the revaluation gain. And we say that the revaluation gain always should be debited in this account. The revaluation gain. So the revaluation gain in our case here is how much? Is it 80? Is that 80? Is that 80? The increase in the revaluation reserve, is it 80? Yes, it is. It is 180. 180, not 80. Okay. This is 180. This is a revaluation gain, which is 180. 180. And should be debited in that account. And then from there, what we need to do is now we balance these two accounts. Okay, where have I recorded that? Sorry. This should be in this account, not the accumulated depreciation. This should be in the PP account, the revaluation gain. Sorry for that, should not be in that account. Yes, so what we need to do is to balance these two accounts. The balancing figure in this account here, the balancing figure in this account, which will be on this side, we said is the depreciation for the current financial year, which was taken in the income statement. In this account, you'll get a balancing figure, or if you get a balancing figure on this side, it represents the PP which were acquired during the current financial year. So let's first of all start by balancing that account, the PP account there. So give me the balancing figure in the PP account. So the balancing figure in the PP account. Balancing figure in the PP account, I might given 1800 by Nicodemus there. The balancing figure in that account, how much? And I hope you don't have any problem in balancing a ledger account. I hope that is not a problem so far to balance a ledger account. To balance a ledger account, you get the total on the debit and also on the credit. So, because the two sides must be equal, the difference, you record it on the side where the totals are less. The balancing figure is what? 40/20, 40/20, which is now the acquisitions. These are the PP, these are the property, plant, and equipment which were acquired during the current financial year. What about the accumulated, the balancing figure in this account, which represent the depreciation for the year? So the total on the debit side, 800 plus 68, which will give us 76 minus what we have on this side, which is 58. And I'm getting a balancing figure here of 800, which is now the depreciation for the current financial year. Yes, so that is it there. So what we need to do, we go to the last point there, the last point. In the last point, what are we told? In the last point, what are we told? We are told that, so we go through that point, we are told what? We are told dividends totaling to 1.6 million were paid. Remember, we say that even if you are not given the dividends which were paid by the company during the current financial year, that is something you can compute using the retained earnings or the retained profit figure in the balance sheet. Sasa? Yes. So we are going to confirm whether the dividends which were paid during the current financial year was 1,600 using that retained earnings figure. So anything with that, we need to proceed and prepare our statement of cash flows. In which case I've said we are going to use now the indirect method because we are given the income statement and also what? The balance sheet of this company. So let's have the title here. The name of the company is 𝗍𝗓 Limited. 𝗍𝗓 Limited. This is a statement of cash flows. Statement of cash flows, which is for the year, which ended 31st of October 2021. 2021. And here we always start by determining the cash flows from operating activities. From operating activities. From operating activities, our figures, they are given in thousands of shillings. So we also need to indicate that here, that our figures are in thousands of shillings. And equally, we need to have two columns. We need to have two columns. Now, under the indirect method, now, Regina, you're asking how we balanced Areja, how we balanced what? How did you balance the accumulated depreciation account? Regina, how do you balance an Areja account? See, balancing Areja account, you get so basically there is something I'm ignoring here. Okay, maybe I can just explain. But you can see in my case, I'm double underlining here. So generally, when balancing a Areja account, what do you do? So you have a place whereby you record your totals here. So in our case, we didn't have that. That is what we are computing. So when balancing a Areja account, you get the total on this side. The total on this side is what? The total on the debit. The total on the debit is what? Is 800 plus 68. That will give us 76. The total on the credit is 58. 58. Then what you do, you pick the amount which is more, which is 76. You record it on both sides. 76, 76. I hope you can be able to see my totals down there. Yes, we know that the total on this side is 76, what we have there. But the total on this side is not 76. So the difference between the two amounts, which is 1800, you record it there as a balancing figure. And you have said that that is what? That represents the depreciation for the current financial year. That's why we needed to prepare that account so that we determine the depreciation for what? For the current financial year. So, sir, yes, you see now Mwalimu is assuming that balancing a Areja account is something you definitely covered in the lower level, because that is the assumption. That is the assumption that you did a unit called financial accounting, and you did something to do with the Areja account, preparation of Areja account, the balancing of the same, the concept of double entry, and so on. But essentially, that's how we have balanced that account. So let's prepare this. Let's prepare this. Okay, Nicodemus. Yes, that is a good reminder. Yes. So to compute now our cash flow from operating activities, we start with the profit. We start with the profit before tax. The profit before tax is something which we get from what? Which we get now from the income statement. Give me the profit before tax from the income statement. I see whether we are moving together. Whether we are moving together. Whether we are moving together. Give me the profit before tax. How much is the profit before tax? How much is our profit before tax from the income statement? Yes, the profit before tax from the income statement is an amount of what? An amount of 6,000. And then we adjust this profit with a number of items. Or to this profit, we make various adjustments. Now, we say that the first adjustment to this profit always should be the finance cost. Should be the finance cost, or in other terms, the interest which was paid. This is what we are given just above the profit before tax. In the income statement, just above a profit before tax, you can see we are given something called interest paid. Now, this interest paid, we said that this amount has been deducted in arriving at that profit, but we said that this is not an operating expense. So, and because we want to determine the money, the cash the company generated from operating activities, so we have to add back that amount, take into account it has been deducted there, but this is not an operating expense. It's not an operating expense. And also in the income statement there, in the income statement, there is another item we are given there, another item which are given there, which is known as interest received. Now, interest received, what is this? This is another name for investment income. Is another name for what? Investment income. So therefore, this interest received is not an income from operation, is not an income from operating what? Activity. So what we need to do is we take into account that interest received. Interest received, I've said that this is a good example of an investment income. And take into account it has been added in arriving at this profit, the amount of 500. So we less it from our profit there, and we are going to take it into account when determining the cash flow from investing activities. The cash flow from investing what? Activities. That is not an income from operation. Yes, I think that's what we have from the face of the income statement, but from the workings which you have done here, the number of items which we need to take into account. The first item is this gain on the sale of investment. The gain on sale of investment. A gain on sale of investment, the amount of 100. We say that this amount here was accounted for as an income. In arriving at this profit, it has been added, but take into account it is a non-cash item. We less it there. We less it there. The other item we also need to consider here is this loss. Loss on disposal. Remember, this was disposal of equipment. This was disposal of equipment. The loss is 260, but this loss, it was accounted for as an expense. Take into account it is deducted in arriving at this, and is a non-cash item. We add it back. So none of the items here will be adjusted in our profit, but from this account, we have this depreciation for the year. Depreciation on property, plant, and equipment, which is an amount of how much? 1,800. Equally, in arriving at this profit, that depreciation has been deducted, and because it's a non-cash item, what do we need to do? We need to add it back. We need to add it what? To add it back there. We need to add it back. Yes. So that's what we have. That's what we have as per the additional information. But always we said before you move to making an adjustment with respect to changes in working capital, is always advisable you go to where we have non-current asset in your balance sheet. You check whether have you dealt with all items there. Like in our case, under the non-current asset, we have dealt with PPE, but also we have intangible asset. Intangible asset, you can see at the start of the year, they had a value of 4,000. At the end of the year, the value for intangible asset increased to 5,000. Now, who can tell us what causes this increase? What makes intangible asset to increase? What makes the value of intangible asset to increase? Intangible asset, you have to remember, comprises of assets such as a copyright, patent, and so on. What makes the value for this intangible asset to increase? Who can tell us what? Who can tell us? Goodwill? No, remember here we don't have. This is not a group cash flow. The issue to do is goodwill. I think you'll come across that in the upper level. So this is a result of acquisition. This is a result of acquisition. Yes. So that will be considered when determining when computing the cash flow from what? Investing activities. These intangible assets which were acquired. But there are some cases whereby you may be given a question whereby there was a decrease in the value for intangible asset, and that decrease you are told it is not due to the disposal. It's not due to disposal. So in such a case, that decrease in the value for intangible asset will be due to something called amortization. You see, intangible asset, these are those particular, for instance, if a company come up with a patent, you see a patent is an innovation. The company is supposed to register this innovation with a person who is called the registrar of the patent. So let's assume that the company in registering that innovation incur a cost of 5 million. So this 5 million is capitalized, is treated as an intangible asset, but the company should amortize it. Remember, you said amortizing an asset is gradually writing off an asset. Gradually writing off what? an asset. Sasa, yes. So therefore, that amount which has been amortized during the current financial year is treated as an expense, but amortization of intangible asset is equivalent to depreciation, is an expense, but is a non-cash item. So therefore, if you're given amortization, you treat it the same way, just like depreciation. You add it now back to the profit there. We add it back to what? To the profit. Yes. Can we also say it is an introduction of a new product? Yes. We can also say that it is introduction of a new product, because the moment the company come up with a new product, the company ordinarily incurs some cost which is known as development costs. Development costs are costs incurred by the company in terms of what? Developing a new product. Those costs are capitalized, and then they are supposed to be what? To be amortized. They are supposed to be amortized. So where do we get interest received? The interest received is in the income statement. Is in the income statement. Is in the income statement, just like the interest paid. Yes. So therefore, let's get the net amount here, so that then we proceed and consider changes in working capital. So whatever we get there, we refer to that as cash flow. Cash flow before changes in working capital. So how much is the amount there? How much is the amount there, so that we consider now the changes. The changes in working capital. We consider the changes in working capital. Yes, we consider the changes in working capital. The net amount here, I'm given what? I'm given that amount by Oscar as 8960. 8960. Zipporah is giving me the same amount. 89 what? 60. Now, what is provided, Yvonne? It is provided. What is provided? Yvonne? What is provided here? Oh, the interest income. Yes, the interest income, I'm saying that this is a part of the income statement there. Yes. So let's consider this, the changes in working capital. Here you have to remember we consider 3 items. We said you just need to remember this. RIP, not rest in peace, but receivables, inventory, and what? Payables. Receivables, inventory, and payables. We said always these are free marks. These are free marks. Sasa, these are free marks. So let's go to the statement of financial position, specifically at the current asset. The first item we have there is inventory. You need to compare inventory at the start and also at the end. So in our case, we can say we have what? Increase in the inventory. We said that whenever the inventory increases, or whenever you have an increase in an item of current asset, that is a cash outflow. And so how much is the increase here? I can see is 960. 960, which is a cash outflow. And then what about the account payables? Account payables also we have increase. Not account payables, sorry. Account receivables. Account receivables, we have an increase. An increase of 1,500. Or 1,500. Any increase in current asset is a cash outflow. Yes. We have considered receivables, inventory. Finally, we consider payables. Payables is part of the current liabilities. Is part of the current liabilities. For payables, we also have increase in account payables. Increase in account payables. Account payables increase from 2380 to 2540. So how much is that increase? Is it 160? Is the increase in account payables 160? 160? Yes, it is 160. And an increase in an item of current liability is a cash inflow. We said that is the rule here. Increase in current asset, cash outflow. Decrease in current asset, cash inflow. The reverse is true for liabilities, for current liabilities. Yes, and then from there we need to consider now, or basically to get the net amount, we take it to the last column. We take it to the last column here. So how much is the net amount? Net amount, I'm getting negative, or a net cash outflow of, yes, 2,300. So we less it from that, and that will give us what? Will give us 66 what? 60, is that correct? Yes. So next, or finally here, not finally, next we less two items, the interest on finance cost, which was paid, and also less tax paid, less tax paid. Now for the interest of the finance cost paid, we said here we check for two items. One, we go to where we have current liabilities, and we check whether we have any accrued interest. Under the current liabilities in our balance sheet, in our statement of financial position, under current liabilities, do we have any accrued interest? No, we don't have. And therefore we said, if the company was not having accrued interest at the start and also at the end of the year, then that means that the interest of the finance cost which we have in the income statement is the amount which was paid. Is the amount which was paid, of which that is a cash outflow. How much is the interest paid in the income statement? The amount interest paid in the income statement is 1,500. So you take that there as a negative because it's a cash outflow. And then for tax, this one we said you have to prepare an account which is called tax account. Tax account. So let's prepare that account here, the tax account, so that we determine the amount of tax which was paid here, which was paid by the company during the current financial year. So I can do away with these two workings, so that we prepare the tax account. The tax account here. So that account, we prepare it to do what? To determine the amount of tax which was paid by the company during the current financial year. Tax paid, or tax account here. Now we said when preparing this account, we always start by recording the opening balance here for deferred tax, current tax, and then we record the closing balance here for deferred tax and current tax. And then the other item which we record in this account is the tax for the current financial year, which is in the income statement. That one we credit it in that account, and then we balance this account. If you get a balancing figure in this on this side, that is a tax refund. If you get a balancing figure on this side, is a tax paid. Now these opening balances for deferred tax, current tax, we said are in the statement of financial position, specifically under current liabilities and other non-current liabilities. So what we do, first of all, we go to the balance sheet, specifically under the non-current liabilities. Under the non-current liabilities, we check whether we have something called deferred tax. In this question, we don't have deferred tax. I hope you can see that. We don't have deferred tax at the start and also at the end. Then from there, we go to the current liabilities. We take the current tax. Now, in our case, we don't have the current tax, but we are given tax. Now, that tax is the same with the current tax. So how much was the current tax at the start of the year? It was 22. At the end of the year, the current tax was what? Was 24. So, and then from there, we go to the income statement. We check how much tax was the company supposed to pay during the current financial year. This is the amount we have in the income statement. Just below the profit before tax, we can see that the tax the company was supposed to pay during the current financial year is 28. So those are the items which you record, and then from there we balance our account. We determine how much tax was paid or how much was the tax refund. So the total on this side is 5,000. The total on this side is 24. So meaning that we have a balancing figure on this side of how much? 26, which is the tax which was paid. That is now what we need here. A tax paid was how much? Was 26. 26, yes. So, and then now here we get the net cash flows from operating activities. Yes, I hope you can see now these questions as we do more questions. The question at least should be becoming a little bit simpler, because you can see we are doing the same thing in all questions. In all questions, computation of tax is the same. Determination of interest or finance cost paid is the same. Determination of changes in working capital is the same. Determination or maybe preparation of the PP account, preparation of a disposal account is the same. So therefore, I hope now this topic is becoming a little bit simple and also more interesting. So I'm given a figure here of what? Of 2560. 25 what? 60. Yes. So that is what? Our net cash flow from operating activities. In other terms, we refer to that as what? CFO. CFO. Sasa? Yes. So then from there, we need to proceed and we determine now what? The cash flow from financing activities. Financing activities. Yes. So I'm told the topic is becoming a little bit easier. And you see, this is not a topic you can ignore, because even in advanced financial reporting, you'll also cover the same concept. You'll cover the same concept, but now in the advanced level, there will be an additional concept, because you'll be covering something called the group cash flow. The preparation of cash flow for a group of companies. So this is a very, very important topic. Very, very important topic. So let's determine now the cash flows from investing activities. Now, cash flow from investing activities here, we said you have to remember that what we consider here are what? Asset acquired and the asset which were disposed. Asset acquired and asset disposed. Asset acquired and asset disposed, together with any income from what? From investment. Cyrus, you're saying what? We start with the investing activities. We start with investing activities. What you mean? What do you mean, Cyrus? That we start with investing activities? Okay, so we check which asset were acquired, which asset were disposed here. And we have a number of such items. So let's go to the additional information. Number one, in note number one, we know there was some investment which was sold. So we take into account that here, sale of investment. Remember, you said once the company sell investment, what we consider here, we consider the proceeds. How much amount was received? In number one, we know that after the company sold those investment, the company received 600,000. In the additional information number two, there was disposal of equipment. there was disposal of equipment. Equally, in that case, what we take into account here are the proceeds. How much amount was received from the sale of equipment? We are given that amount as 640. And remember, all these amounts are cash inflows. That's why we're recording them there as positives. And then from the information we have in note number 3, we prepared this account here, the PPE account. And from this account, we were able to determine that during the current financial year, the company acquired PPE, which had a value of what? Of 4020. So during the current financial year, there was acquisition of property, plant and equipment, which had a value of 4020. And this is a cash outflow. So recorded there as a negative. Yes. So and then in the additional information number 4 is all about dividends. So those dividends, we don't consider them here. That is considered when determining cash flow from financing activities. But equally, before you determine now the cash flow from financing activities here, it's always advisable you go to where we have the non-current asset in your balance sheet. You check whether you have dealt with all assets which are given there. First of all, we have dealt with PPE. We have taken PPE, acquired PPE, disposed. But below that, what do we have? Intangible assets. Remember, for the intangible asset, we have an increase, and we say that this increase from 4,000 to 5,000 is due to what? Acquisition. Is due to acquisition of additional intangible assets. Intangible what? Assets. So, and the acquisition of additional intangible asset is equal to the increase of 1,000, which is equally a cash outflow. Which is equally a cash what? Outflow. So below the intangible asset in our balance sheet, we have investment, and we know that those investments were sold, and we have already considered that there. The other item we should not forget to include here, we should not include here is any investment income. Any investment income. In our case, we don't have investment income, but what you're given in the income statement is interest received. Interest received, I've said these are an interest which is received by the company from investment undertaken. You can see this company had made some investment which were sold during the current financial year. So therefore, this is an income from what? Investment. Interest received is an income from what? Investment. So we consider that here because we want to determine how much cash was received from what? Investing activity. So the interest received in the income statement is 500, and this is a cash inflow. That is a cash what? Inflow. So those are the items which you consider there. Asset acquired, asset which was sold, together with any income from what? Investment. So we get the net amount, we take it to the last column. So how much is the net amount there? How much is the net amount there? The net amount I'm given a net cash outflow of 3280. And finally, we need to determine the cash flow from financing. The cash flow from financing activities. Cash flow from financing activities. We also say that determining this is very, very simple because all the items which we include here, we get them from the statement of financial position, specifically under the equity section and the non-current liability section. So let's go to the statement of financial position or to our balance sheet, specifically under equity section. Under equity, what are we provided with? The first item we have under equity is the share capital. Share capital at the start 3,000. At the end of the year, it was 4,000. So in our case, we can see the share capital increased, and this increase in share capital is due to what? is due to the issue of what? Of ordinary shares. So we take into account that here. So, and the share capital increased with how much? 1,000. So this increase in 1,000 is a cash inflow, is money received by the company from issuing shares. Then below that, what do we have? We have share premium. Share premium at the start 3,000, at the end 32. 3,000 at the end of the year 32. So we have an increase in the share premium by 200. And basically what that means is that these shares which were issued by the company, they were issued at a premium. And therefore, that increase in share premium is also considered here, increase in share premium, because now this represents the amount of money which was received by the company, and which was the share premium, which was the share what? A premium. So then below that, what do we have? Below share premium, we have revaluation reserve. Revaluation reserve, we say that one, we don't consider it here because that is a non-cash item. That item changes due to revaluation of asset. It is a non-cash item. When preparing our statement of cash flow, we only take into account those items which involve a movement of cash. Whenever the company revalue asset, that is a non-cash item. We don't consider that here. And then the last item which we have there is the retained earnings. The retained earnings, this one, we said we use it in terms of computing the dividends which were paid. But in our question, in note number 4, we are given the dividends which were paid as how much? 1,600, which is a cash outflow. But basically, we can confirm. Remember, we said in most of the questions, like I think the questions which we did, the question for August and also for December 2022, we were not given these dividends, and therefore we said we compute this using the figure for retained earnings. We take the retained earnings at the start, which is 36. To this, we add the profit after tax, or the profit for the year in the income statement. The profit after tax is what? 32. And then we less the retained earnings at the end, which is what? Which is 52. So that should give you that figure. Is that coming to that? Because here, yes, it's coming to 1,600, because here we have what? We have 68 minus 52. Minus 52. So that will give us what? 16. So that's how we compute the dividends which were paid. So you use now the retained earnings figure to compute the dividends which were paid. So we are through with that. We are through with that. We are through with that. Finally, we go to the non-current liabilities, to where we have non-current liabilities. For non-current liabilities, we have only one item, and that is long-term loan. Long-term loan at the start 1,000, long-term loan at the end of the year 34. So meaning that we have an increase in long-term loan. What causes a loan to increase? If you have a loan balance of maybe 100,000 at the end of the year, and maybe that is at the start of the year you have a loan balance of 100,000. At the end of the year you have a loan balance of maybe 350. What will cause your loan balance to increase? Interest, additional loan, and repayment. You have topped up. You have done what is referred as a top up. You have gone back to your bank, and you have requested your bank to do what? To do what is referred as a top up, to add you an additional loan. So therefore, that increase in long-term loan is due to what? Acquisition of an additional loan. So we have acquisition of long-term loan. Acquisition of long-term loan. And the increase in our case here is equal to 24. So this increase in or this acquisition of a long-term loan to this company, is it cash inflow or cash outflow? Whenever the company acquires an additional loan, does that involve inflow or outflow of cash? Yes, that is automatically cash inflow. That is automatically cash inflow. Yes, and in our case, we are through. We are through. So I hope you can see where we have gotten all those items. All these items, equity section, and also the non-current what? Liability section. So in that case, we should not struggle in terms of getting all those items to be included there. So what do we need to do? We need to get the net cash flow from what? From financing activities. So let's work out all that. It will give us what? 36. Yes. So there is a net cash inflow of what? 2,000. Finally, then we determine the net changes in cash and cash equivalents. Net changes in cash and cash equivalent. How do we determine this? We said we determine that by adding the net cash flow from operating activities, net cash flow from investing activities, and net cash flow from what? Financing activities. So we get the net changes in cash and cash equivalent. Yes. So what are you getting? The figure? What are you getting? I'm given 1280. So to this, what do? We add the cash and cash equivalent. Balance brought down. Cash and cash equivalent at the start of the year. So we said cash comprises of cash in hand, cash at bank, and also bank overdraft. And then the cash equivalent, these are short-term investment. These are short-term what? Investment. So let's go to this to the balance sheet which are given there, specifically under the current asset. Under the current asset, what do we have? Which items of cash and cash equivalent do we have there? I think first of all, we have the short-term investment. The short-term investment at the start of the year was how much? Was 0. The short-term investment at the start of the year was 0. What about the cash in hand at the start? Was 20. Was 20. And then we check whether we have a bank overdraft. Let's go to where we have current liabilities down there. Under the current liabilities, we have a bank overdraft. Yes, we have a bank overdraft of 1960. A bank overdraft, we said, we always take that as a negative. As a negative, this is money which is owed to the bank. 1960. So how much is our net amount there? 0 plus 20 minus 1960. That will give us a net amount of how much? That will give us a net amount of how much? Yes, will give us a net amount of 1940. So we add the two. We add the two figures there. So 1280 minus 1940. That will give us a cash and cash equivalent at the end of the year, which is balance carried down. So how much is the amount? Is negative 660, or net cash outflow of what? 660. So we said that this should be the same with the cash and cash equivalent at the end of the year as given in the statement of financial position. So let's go back to the statement of financial position, specifically under the current asset. Under the current asset, what do we have? We have short-term investment at the end of the year, which is 1,000. That is part of cash equivalent. And then we also given cash in hand of 40. How much is our bank overdraft? The bank overdraft is 1,700. So we less 1,700. So whatever this will give us, we say it should be the same with what we have there. with what we have there. So just confirm whether it's coming, it's giving us the same figure, the same amount. Are you getting negative 660? Yes, so the amount is the same, negative what? 660. So that is it, that what was required in that particular question there. That is what was required as far as that question is concerned. And that brings us to the end of that topic. The topic was preparation of the statement of cash flows in accordance with what refers as IS what? 7. Basically, I've seen these are a very, very important topic, and that's why you can see it is covered in all levels. So in foundation level financial accounting, it is covered there. In intermediate level financial reporting and analysis, it is also covered there. And I've said there's also something you're going to do in advanced level in the subject called advanced financial reporting and analysis. You're also going to cover this, the same concept, but at the advanced level, you'll be covering or you'll do something called the preparation, or you'll do something called the group, or something called the consolidated what? Cash flow, maybe with some additional few concept. So, but that brings us to the end of that particular topic. So for today, I think we're going to stop at that point because we can't start on a new topic. So, but once we meet in our next class, that is on Saturday, we're going to proceed to the other topic. And therefore, what you have done here, I think the last 3 topics which you have done are very, very important, because I think we have looked on something to do with the preparation of preparation of what? A public financial statement. We have looked on the analysis of the same, and also we have covered something to do with the group, not the group rather, the preparation of the cash flow. So this is an area which is very, very common, because we said if you look on all the papers which have been tested since last year on August, we have what? A question on analysis, and also a question from the topic of what? The published financial statement. So therefore, what the last 3 topics, or the last 2 topics we have covered, published, the cash flow, and also the analysis, those are very, very important topics. So I think in our next class, what do we need to cover? I think we're going to proceed to the topic of partnership, whereby you're going to look on something to do with conversion of partnership into a limited company. So far, I think we are almost at 70 or 60% of our syllabus coverage. So we don't have much which is remaining, because the main topic which is remaining is, I think, group accounts, the group accounts. So once we do something to do with partnership, conversion of partnership into a limited company, I think we will do public sector accounting. And then I think from there, we're going to look on the topic of what? Of the group account. So therefore, I think for today, unless maybe there is a question. Oscar, where do you have a topic like insurance in the syllabus? No. So maybe for those who had done the unit some time back, so there are some topics which have been removed, like insurance is no longer part of financial reporting. Banking is not part of this. Some of the topics have been moved to the advanced level, like insurance, banking, and so on. So So in our next class, I think we're going to look on that topic of conversion of partnership into what? Into what? Into a limited company. So do we have any question here? So on Saturday, we did a question on cash flow, and I think that video was shared. That video was shared. That video was shared. That video was shared, Hilary. Was shared. I saw it somewhere. So try to create some time, you go through it. Okay, do we have any other question here? Okay, so let's just stop at that point for today. We meet on Thursday as we start a new topic. So have a good night. Have a good night. See you on Saturday. Not on Saturday, but rather on Thursday. Have a good night.